Hi, I'm Max Keiser. Welcome to On the Edge. Okay, let's go to Washington, D.C. and speak with Ed Harrison of CreditWriteDowns.com. Ed is a former career diplomat, investment banker, technology executive with over 20 years of business experience. Ed, welcome back to On the Edge.
Max, it's great to talk to you.
All right, Ed Harrison. Goldman Sachs is predicting QE3, a third round of quantitative easing sometime in April or May. What will another round of quantitative easing do to the U.S. economy if, in fact, one comes? Your thoughts?
It won't do anything at all. Really, it's just a swap. It's an asset swap. They're swapping out reserves for bonds. It's not going to do anything, just as it didn't do anything in the last few goes around. Basically, what it does is it causes people to shift their private portfolio preferences. So if you're investing and you're getting swapped out of your bonds, now you have money. What are you going to do with that money? Where are you going to invest that money? Some of it's probably going to go back into bonds, but other parts of it's going to go back into speculative assets. Some of it might go into commodities or into gold because, the bar for holding gold or holding commodities is lower when interest rates are at 0%. So the Fed's holding interest rates at 0%. Then they're going to, if they did QE3, pump money into the economy, which essentially gives you a green light as an investor to go and invest in commodities or gold and things of that nature.
Yeah, talk about green light for a second. I got a tweet from Jim Rickards, and he mentioned that in anticipation of this move by the Fed, buying essentially what he believes could be agency paper. This would be the Fannie Mae and Freddie Mac type paper. The hedge funds and those folks are already positioning themselves ahead of that move, and so they'll be bought out at a premium. Is that where the money is going to flow in your thought? Do you believe also? And if so, isn't it kind of interesting that this information in today's day and age is such where hedge funds are privy to what's happening down the road and are able to position themselves? It's almost as if they have very little risk in what they're doing in terms of aggregating wealth. Your thoughts?
Well, they definitely have little risk because, the Fed actually now, in terms of its communication strategy, it's talking to investors ahead of time. So these investors, some of them know exactly what's going to happen, or they have at least an inkling of what's going to happen because they've actually talked to the Fed, because the Fed wants to be able to telegraph its policy. The new Fed policy is basically to communicate its what it's going to do as directly as possible to make sure that its communication strategy is working. And the reason it's doing that is because interest rates are 0%. It's not as if the Fed can go in and then lower interest rates in order to spur on the economy. So whenever they want to have any sort of influence over the credit markets, what they have to do, therefore, is go with the whole concept of communications. And that gives people a certain edge in the economy. They know whether it's going to be mortgage-backed securities or whether it's going to be more QE of Treasury securities. And so they can position themselves ahead of time. And then when the Fed actually goes in and buys those securities, that's good for them because they have already secured their profit. So it's a direct, subsidy for those companies.
Yeah, those are interesting terms here. One is front running. Is a clear case of front running, and in the context of what we've seen banks like Goldman Sachs or J.P. Morgan doing recently that have engendered, let's say, the famous Greg Smith editorial in the New York Times criticizing Goldman Sachs as being a bank that puts itself before its clients by front running its own clients. What you're describing here is front running on a different scale, a different venue, if you will, but it is nevertheless privileged insider information, or it's not so insider because Bernanke does communicate this when he tests with his public relations, but it's information that the average person can't really avail themselves. They don't have the economies of scale. They don't have the zero cost of credit to take advantage of. So it does work out to a subsidy. Now, you're in Washington, D.C., and people in Washington...
Let me tell you something, though. The fact is when you think about back during the bailout when Lehman Brothers went bankrupt, Goldman Sachs was the only company in the room. They actually had Goldman in there in order to, they wanted to get a market player who knew what was going on, who could tell them, et cetera, what impact this would have, et cetera. So they had inside information in that particular regard. And you have to ask yourself, do you blame Goldman or do you blame the government for that? Because ultimately they invited these companies in to get the privileged information. No one told them that they had to do this. So the government is on the hook for giving these companies privileged information that you and I do not have.
Right. To some appearances, it would appear as though Goldman and other Wall Street types, but in this case Goldman, has leverage over government policymakers in ways that almost appear as though the government policymakers are, you could say, being held hostage to some degree. But I wanted to ask you, actually make a bit of a digression here. So much has been made recently about this case about insider trading in Congress. You're in Washington, and insider trading in Congress is to some degree legal. And there is a bill recently trying to curb that information flow. Can you give us a little background on this and what the current state is of this inside information trading between Washington and Wall Street, and then your thoughts on how this is either appropriate or inappropriate?
Well, I haven't followed where the legislation is in route now. What I do know is you had that expose in 60 Minutes, which brought it to bear. Everyone found out that basically Congress people were trading on insider information. They were betting against the economy in certain cases when the economy was tanking and profiting from that. And so there was naturally outrage. But in Washington right now, it's all about the Republican nomination. It has nothing to do with any of these other issues. So in an election year, I don't think that any of this will go anywhere. What Congress wants to happen is they want this to be deep six. They want the election cycle to take over, to control the news cycle, and for this issue to go away completely. Only at some point later on, if someone within Congress is really dogged about it, is it going to rise. But I hear almost nothing about this issue whatsoever.
All right, let's get back to quantitative easing for a second. The Fed communicates its intentions. They are involved in a program of both enacting monetary policy as well as, you could call it, a form of subtle propaganda, where they're trying to steer expectations, because markets do react to expectations as much as they do to raw price data. And as a result of this current thinking or communication that QE is in remission, people were dumping their gold. At the same time, however, it appears as though central banks, who have a seat at the table in terms of knowing what these policymakers are going to do, have been accumulating gold. Is there a mismatch of information here? And is that by intention? And is it healthy? And what's the takeaway from this? That people should just understand that what the Fed comes out of their mouth is in many ways a way to affect the psychology as much as the reality.
Well, yeah, I think you make an interesting juxtaposition there with regard to these central banks buying up gold while the whole QE talk has died down. I'm not sure whether the Fed itself is buying gold, or if it's rather, you have central banks in emerging markets that want to hedge out of the dollar and get into gold and things of that nature. So it's not clear to me that we should definitely see a connection there. But it is clear that the Fed is managing expectations, as you were saying. And I think the reason that they're doing this, again, is because of zero rates. But more than that, it's the fact that with rates at 0%, the Fed has basically no control over the short end, because there's no much lower that you can go. So instead, what they're trying to do is affect the spread there. They're trying to get you to get into 10 years or 30 years and affect the yield on 10-year bonds and on 30-year bonds. They've already done and gone out and said, look, we're not going to raise interest rates for another 2.5 to 3 years until the end of 2013. So you can leverage up and do the carry trade and we won't do anything, and that's a safe bet. So that's what everyone's doing out to 2 years. But the question is what happens in the 10 and 30-year spectrum? And so more and more now, the Fed it has to go into the 10-year and into the 30-year and start to manage expectations on what's going to happen. And what they've done basically is said that we're going to be an easy street as far as you know. It's safe for you to pile into these assets to a certain degree because our policy is going to be to keep rates low. And people have done that. Of course, we've seen a little bit of a negative reaction recently where rates have gone up, but the Fed would then, in that case, communicate again that, look, we're still going to be on easy street, and it's safe to pile into these assets again. So that's what you would expect if the market takes another negative turn.
Right. The central bank buying has been flowing through the Bank of International Settlements on behalf of its member banks. The BIS, of course, is kind of the master central bank that rides above all of the country central banks around the world. So this is where we're seeing the gold buying. But you mentioned this interesting operation of buying 10 and 30-year paper, treasury paper, to keep the interest rates low. And some call this a form of financial repression. And what they mean by this is that there is a portion of society that's getting hurt by this. This would be the savers, people living on fixed income, people living on pensions, and to some extent even you could say wage earners. So this group of society is in effect subsidizing the more natural constituents of the Fed, that would be the bankers on Wall Street. So is this financial repression? And is it, in fact, true that you have one huge portion of society, savers, people with money and living on fixed income, retirees, subsidizing the bad behavior going on in the banks that got this trouble to get going to begin with?
100%. And, let me give you the counter argument before I tell you exactly what I think about it. Because a lot of people, I have a lot of colleagues who are of the modern monetary theory group, and they tell me that this isn't financial repression whatsoever. And in fact, what's happened is that it's just rentiers going in there and arguing that they deserve a free lunch, they deserve some sort of free yield. There's no guarantee of yield. The Fed is the monopoly supplier of reserves, and they can dictate whatever yield they want. It's a public monopoly, and therefore it's up to them to decide what they're going to do. That's the argument, and the argument continues that in fact, if we would actually increase Social Security payments rather than trying to cut them, none of these people would have any problem whatsoever. Now, I think that the whole argument, I agree that the Fed is the monopoly supplier of reserves, but I think the whole argument's false because at the end of the day, there's no direct connection between yields and Social Security. It's not like the Fed's going out there and saying we're going to repress these yields, and therefore we know that on the other side of the political spectrum, they're going to increase Social Security. That's not what's happening. What's happening is people like my mother, people like your mother, they're getting crushed. They were getting 5 to 6% on their CDs 5 or 6 years ago, and now they're getting 1%, 2%. That's ridiculous. And so basically, this is below the rate of inflation. They are getting, it's like the Fed has reached into their pocket and stole money from them. And it's an abomination that we allow this to continue to happen. So it's completely a subsidy for the banks, and there's no way, no how this should ever go on. And it's going to continue unless we get someone in there who's going to put a stop to this.
All right, now, I understand your second point, and that would be what people call financial repression, that the Fed is stomping on rates as a way to transfer wealth from savers, people who have worked all their lives to save money, and transfer that wealth to speculators. But I'm not sure I understand your first point. I wanted to take another look at it. You're talking about MMT, modern monetary theory. I believe that this group is concentrated in the University of Missouri, Kansas City. If I'm not mistaken, that's their stronghold.
That's right.
And if I understand this correctly, they're arguing that in the face of these lower rates by the Fed, the the quantitative easing that jams down 10 and 20-year rates, that this would be the prerequisite to argue for higher Social Security payments?
Yeah, it's their argument is basically that in the first instance that the Fed it's a monopoly supplier of reserves, and therefore, as monopolists, they can decide what the rates are. And in fact, they feel that the Fed, instead of manipulating rates constantly, they should just keep the rates at 0% anyway, and have low interest rates and low taxes at the same time. Why not lower the tax rate? Lower the interest rates, just get the Fed out of manipulating interest rates altogether. There's a certain, I think, logic to that. I don't accept that because it's basically central planning in my estimation. I mean, what if you had someone who said, you know what, the price of sugar, we're going to set it in the whole United States permanently at $1.25 a pound, and we're going to have these 12 guys over here decide exactly what the price of sugar is going to be. And when they think that the price of sugar is too low, they're going to increase that price. And when it's too high, they're going to decrease it. That's ridiculous. It's basically, socialism, communism, central planning. It doesn't work. And so when the Fed is artificially manipulating rates lower, what happens then is that you get a misallocation of resources. You get people piling in to assets because their preferences, their portfolio preferences shift. What's my mother going to do when she's getting 1 or 2% from CDs? You don't think that she's going to put all her money in CDs at the local bank. She's going to start speculating in alternative assets. And that's exactly what the Fed wants, and that's why they're doing it.
All right. I want to switch gears here for a second and look at technology sector. First of all, I don't know if you've covered this or not, so I'm going to bit of a digression. But in the internet space over the past few years, you write a column, creditwritedowns.com, so I believe you probably have taken a look at this. There's been the emergence of competing lending models coming from so-called P2P lenders, where people can apply for loans and on the web, and those loans are met by people who are lending out. The result is that the cost of the loans are considerably cheaper than what one would get at a commercial bank, and then the rate of interest that one is accumulating as a result of having made that loan is considerably higher than what you get on the CD market. So it has disintermediated the banks, taken the banks out of the equation, taken all this quantitative easing and all this financial repression off the table, and it's P2P, peer-to-peer, the people themselves recreating online an inadequate banking function. Have you looked at this? What are your thoughts?
Yeah, I have looked at that. Keiser Research, they're an outfit, I think, in Vermont or New Hampshire, and they did a little article that we carried at Credit Write-Downs, and this I thought was interesting. And I think that, it's definitely about disintermediation. Obviously, when you have the banks and the central bank falsely and artificially changing the environment for credit, then there's the opportunity for people to get in there as a result of that disintermediation. So I think that's a positive thing. The negative thing, obviously, is this is a completely unregulated market, and as a result, the potential for massive losses of those people who are lending money is pretty large. Basically, you are the lender, and you're lending to other people. The question is who's making those lending decisions? What happens when those loans go bad? How much of a hit do you take? The way that our system works now is that we have banks that are a buffer. They have a capital buffer. They make the lending decisions, and to the degree that they make bad decisions, they either go bankrupt or their capital gets eaten away. I think that it's a tightly regulated environment. And, it's like the Wild West with this other environment. And I think bad things are going to eventually happen there as a result of that.
Well, just to fill in the gaps here, in fact, these peer-to-peer lenders, the way they're set up is with a buffer, and the repayment schedule is 98%. And for the 2% that the loans are not forthcoming, that the buffer kicks in. So they're actually more capitalized than all of the current insurers in the so-called regulated marketplace. For example, AIG sold credit default insurance, what we found out later, was that there is no such thing as a credit default swap, and that there is no such thing as credit default swap insurance. So the marketplace, the people, if you're a libertarian and you believe in open, free markets, they stepped in and they've created a solution where the banks have pulled away from having an ethical marketplace. But I wanted to stick on this technology theme for a second. The sector is booming. You got Apple at almost $600 billion, IPOs for Facebook and Twitter, and things are hot. What's happening?
Boom equals bust. I mean, whenever there's a boom, there's going to be a bust at the end of the day. I mean, it's good to have a rise, but when you talk about booms, that means a big rise. And big rises always lead to bubbles and then to bust. So, I'd be skeptical here. When you say, basically, you can say this time is different. We're not going to have a boom that then turns to bust. Prove to me that that's the case. The reality is that interest rates are incredibly low. People are shifting their portfolios into riskier assets, things that require longer lead times. You have things like Groupon, and basically, eventually, you're going to see a shakeout in that sector. So I'm not optimistic that you can get in there at this particular juncture without getting your fingers burned. The time to get in there would have been early 2009, early 2010. But now things are taking off. You mentioned Apple. Apple's up 45% in this year alone. So that's in 3 months, 2.5 months. And it's the largest cap stock in the world. Do you really think that the largest cap stock in the world will be going up 45% in a 2.5-year period, then suddenly is paying out dividends, and that's going to be a story that's going to continue on in a positive way, that you're going to make lots of money there? If you do, well, good luck to you.
Well, the company itself is buying back billions of its own stock, so clearly they see value there. Anyway, Ed Harrison, we're out of time. Thanks so much for being on The Edge.
Thank you for having me, Max. Look forward to it again.
All righty, and that's going to do it for this edition of On the Edge with me, Max Keiser. I want to thank my guest, Ed Harrison from CreditWriteDowns.com. If you want to send me an email, please do so on the edge at PressTV.com. Until next time, Max Keiser saying bye, y'all.